Your neighbor Dave just sent his mortgage company an extra $1,000. Again, he does this every month. He's got a spreadsheet that shows he'll be debt-free in 16 years instead of 30. He's telling everyone at the barbecue about it. Meanwhile, his other neighbor, Jenny, is making minimum payments on the same rate mortgage and investing that extra $1,000 instead. In 30 years, Dave will own his house free and clear and have about $1 million in investments. Jenny will also own her house free and clear, but her portfolio, $1.8 million, $800,000 more. Same income, same discipline, different spreadsheet. And here's the thing that makes this really interesting. Most of Dave's friends think he's the smart one. There's a religion in American personal finance around paying off your mortgage early. It's treated like a moral imperative, like you're somehow irresponsible if you're not throwing every spare dollar at that loan. And I get it. Debt feels bad. Having a mortgage feels like carrying around a backpack full of bricks. But what if I told you that for most people under 45, aggressively paying off your mortgage is probably the biggest mathematical mistake you'll make in your wealth building years? Not because debt is good, not because I'm trying to sell you some leveraged real estate scheme, but because of something way simpler. Something you learned in high school and then forgot. We're going to walk through exactly how this works, why the math is so misunderstood, and more importantly, why your brain is working against you on this decision. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's a central metaphor I want you to hold in your mind. Think of your mortgage as a very slow leak in your boat. It's steady. You know exactly how much water is coming in, 5.3% per year, let's say. Now you've got a bucket. That's your extra $1,000 per month. You can use that bucket to bail out the leak faster, or you can use it to catch fish that multiply over time. The fish multiply at roughly 9% per year if you're investing in a diversified index fund, which is the historical long-term average return of the stock market. So the question becomes, do you bail out a 5% leak faster, or do you catch 9% fish? The answer seems obvious when you frame it like that, but somehow, when it's your mortgage, your brain short circuits. Let me show you why this happens. There are 4 levels to this mortgage payoff trap, and each one is going to make you more uncomfortable than the last. The first level is the basic math everyone gets wrong. Let's say you're 30 years old. You just bought a $500,000 house with a 30-year fixed mortgage at 5.3%. Your monthly payment is about $2,768 in principal and interest. Now, you're disciplined. You've got an extra $1,000 per month you could either throw at the mortgage or invest. If you pay extra on the mortgage, you'll have it paid off in 16 and a half years instead of 30. That feels incredible. Then you take that full $3,768 per month and invest it for the remaining 13 and a half years until you hit that 30-year mark. At the end, you've got a paid off house and about $1 million in your investment account. Not bad, right? Here's the problem. If you had just made the minimum payment and invested that extra $1,000 per month for the full 30 years, you'd still have a paid off house. But your investment account would have $1.8 million in it. That's $800,000 you just left on the table because you were in a hurry to feel debt free. And remember, I'm using 5.3% as the mortgage rate. A huge chunk of mortgages written between 2000 and 2021 were under 4%. Some were under 3%. If we ran this same scenario with a 3% mortgage rate, that gap becomes over $1 million. You literally gave up $1 million to feel good. But here's where it gets really interesting. The second level is about compound growth and something called sequence of returns risk, which is just a fancy way of saying when you invest matters as much as how much you invest. Your investment returns in the early years have a dramatically larger impact on your final number than returns in later years because of compounding. Every dollar you invest at 30 has 30 years to double, then double again, then double again. Roughly 3 doublings over 30 years at a 7 to 9% return. That turns every $1,000 into about $8,000. But if you wait until you're 46 years old to start investing, after you paid off your mortgage, those dollars only get about 13 years to grow, maybe 1.5 doublings. So your $1,000 only becomes about $2,500. You cut your future purchasing power by more than 2/3 by waiting. This is why I keep saying the time value of money isn't some abstract finance concept. It's the difference between retiring at 55 and working until you're 70. And the kicker here is that this math doesn't care about your feelings. It doesn't care that Dave Ramsey told you to be debt-free. It doesn't care that your parents paid off their mortgage early and it felt great. The math is the math. Compound growth rewards people who start early and stay consistent, not people who wait until they feel safe. Now you might be thinking, okay, but what about the psychological peace of mind? What about sleep? What about not worrying? And this is level 3. This is where I'm going to tell you something uncomfortable. Your need for psychological peace of mind around your mortgage is probably a symptom of a deeper problem, which is that you don't understand how money actually works and that ignorance is expensive. Let me explain. Debt isn't inherently good or bad. It's a tool with a cost. That cost is the interest rate. If you can reliably deploy capital at a higher rate than the cost of the debt, you should use the debt. This is not controversial in business. Every successful company uses leverage. Apple has debt. Microsoft has debt. They have debt while sitting on billions in cash because the debt is cheap and the alternative uses of that cash generate better returns. But when it comes to personal finance, we abandon this logic and start treating all debt like it's a moral failure. Here's what's actually happening in your brain. You're confusing two different types of debt. There's consumer debt, which is you borrowing money to buy things that go down in value. Credit cards at 22% interest to buy a TV. A car loan at 7% for a depreciating asset. That debt is bad because the cost is high and there's no offsetting return. But mortgage debt on your primary residence at 5.3% isn't the same thing. You're not borrowing to consume. You're borrowing to own an asset that historically appreciates at roughly 3 to 4% per year, and you're living in it, so you're saving rent. The debt itself is neutral. The question is just, do you have a better use for the capital? And if you're 35 years old with a 30-year time horizon, the answer is yes. You invested, but let's go even deeper, because level 4 is where this gets properly weird, and most financial advisors won't tell you this part. Your mortgage is actually getting cheaper every year, and you're paying it off with inflated future dollars. This is the part that breaks people's brains. Let's say your mortgage payment is $3,000 a month today. In 10 years, if inflation runs at 3% per year, which is roughly the historical average, that same $3,000 payment will feel like you're paying about $2,228 in today's purchasing power. In 20 years, it'll feel like $1,654. Your income presumably goes up with inflation. Your mortgage payment doesn't. So every year you hold that mortgage, it becomes a smaller and smaller burden relative to your income. This is called inflation arbitrage, and it's one of the most underrated wealth building mechanics available to regular people. But if you pay off your mortgage early, you give up this benefit. You're taking today's expensive dollars and using them to pay off tomorrow's cheap debt. It's backwards. Let me give you a concrete case study so you can see this play out with real numbers. Meet Marcus. He's 32 years old. He just bought a house in Austin, Texas for $600,000. He put 20% down. So he's got a $480,000 mortgage at 5.7%. His monthly payment is $2,802. Marcus makes $140,000 a year. After taxes, retirement contributions, and expenses, he's got about $1,500 per month left over. He's disciplined. He wants to build wealth. He's got two options. Option 1, throw that $1,500 at the mortgage every single month. Option 2, invest it in a boring S&P 500 index fund and just pay the minimum on the mortgage. Let's run both scenarios to age 62. If Marcus goes the debt-free route, he pays off the mortgage in about 14 years when he's 46. Then he invests $4,302 per month, which is his old mortgage payment plus that $1,500 for the next 16 years until he's 62. At a 7% return, which is conservative for the stock market, he ends up with about $1.1 million. He's also got a paid off house worth, let's say, $1.2 million after 30 years of appreciation. Total net worth, $2.3 million. Not bad. Now let's run the alternative. Marcus invests that $1,500 every month, starting at 32, and he just makes minimum payments on the mortgage. At 62, his investment account has about $1.9 million. His house is worth the same $1.2 million, and it's also paid off at that point because he made payments for 30 years. Total net worth, $3.1 million. That's $800,000 more. And here's the really uncomfortable part. If Marcus has kids and wants to pay for college, and he's the debt-free guy, he has way less liquidity in his 40s when he needs it. All his wealth is locked up in his house. He can't pay tuition with his kitchen, but if he's been investing all along, he's got a liquid portfolio he can draw from. This is the liquidity trap nobody talks about. Paying off your mortgage early concentrates your wealth in the least liquid asset you own. Now, real quick, here's the conversation that happens when you bring this up. You're at dinner, your buddy says he's throwing an extra $2,000 a month at his mortgage. You say, why not invest it instead? He says, because Dave Ramsey says all debt is bad. You say, Dave Ramsey filed for bankruptcy in his 20s because he over-leveraged on real estate. So now he has PTSD about all debt and teaches a system that's good for people with no financial discipline, but suboptimal for people who can actually manage money. He says, well, what about the peace of mind? You say, peace of mind is expensive. You're paying about $800,000 for that feeling. Maybe just go to therapy instead. Or here's another one. You're talking to your dad. He says, I paid off my mortgage in 15 years, and it was the best financial decision I ever made. You say, Dad, you bought that house in 1987. Your mortgage rate was 11%. Paying off an 11% loan early is completely rational. My mortgage rate is 3.2%. It's not the same decision. He says, debt is debt. You say, no, Dad, cost of capital is cost of capital. You made the right call because your alternative investment options in the 80s and 90s were way more volatile and your debt was expensive. My situation is different. This is the thing. Financial advice from the 80s and 90s doesn't automatically port forward to 2026. The context changed. Mortgage rates collapsed. Index fund investing became free. Tax advantage accounts expanded. But the advice stayed the same because it feels morally correct. Here's what actually matters when you're making this decision. 3 things. First, your age and time horizon. If you're over 50, paying off the mortgage makes way more sense. Your wealth multiplier is lower because you've got fewer years for compounding to work. You're shifting from wealth accumulation to wealth preservation. De-risking is rational. But if you're 35, you've got 30 years. Invest. Second, your actual interest rate. If you refinanced during the pandemic and you're sitting on a 2.75% mortgage and someone offers to pay off your loan for you, you should say no. That's essentially free money. Inflation alone is running higher than your interest rate. But if you bought in 2023 and you're at 7%, the math gets murkier. You might still invest instead, but it's closer. Third, your risk tolerance and liquidity needs. If you're the kind of person who cannot sleep at night knowing you owe money, fine, pay it off. But understand, you're making an emotional decision that has a quantifiable cost. And if you might need access to cash in the next 10 years for kids, health stuff, business opportunities, whatever, locking all your money in your house is a bad strategy. You can't pull equity out without either selling or getting a home equity line of credit, which is just new debt anyway. Here's the part that nobody says out loud. The reason so many people are obsessed with paying off their mortgage has nothing to do with math and everything to do with their parents' experience and their own financial insecurity. If you grew up watching your parents stress about money, debt feels dangerous at a visceral level. If you went through 2008 and saw people lose their houses, you want yours locked down. These are understandable emotional responses, but they're not rational financial strategies for someone in their 30s with a stable income and a 30-year time horizon. Your parents' depression-era scarcity mindset is not a wealth-building framework for 2026. And this is my broader point about the psychology of money. Most people don't have a math problem. They have a fear problem. They make financial decisions to minimize emotional discomfort, not to maximize long-term wealth. And that's fine if you understand the trade-off. but most people don't. They think they're being smart and disciplined by paying off debt early, when really they're just expensive, their anxiety. I've spent 10 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves. I've got multiple hundreds of thousands of dollars invested. Skin in the game, not theory. And here's what I've learned. The people who build serious wealth aren't the ones who are debt-free the fastest. They're the ones who understand the cost of capital, the time value of money, and how to deploy resources efficiently. They're comfortable with strategic debt because they've done the math and they understand that a 5% loan is not a crisis when you can generate 8% returns. They're also comfortable with liquidity and optionality. They'd rather have $1 million in investments in a mortgage than a paid off house and $200,000 in investments, because the first scenario gives them way more flexibility if life happens. Now, let me be very clear about what I'm not saying. I'm not saying go get a cash out refinance and YOLO it into Tesla stock. I'm not saying debt is always good. I'm not saying you should carry a mortgage into retirement if you don't want to. What I am saying is that for most people under 45 with a mortgage rate under 6%, paying extra on that mortgage instead of investing is leaving a massive amount of money on the table. And the justification is usually emotional, not mathematical. So here are your 3 takeaways. 1, run the actual math for your situation. Not vibes, not what Dave Ramsey said, not what your parents did, your specific mortgage rate, your time horizon, your alternative investment return assumptions. Most people have never actually run this calculation. They just assume paying off debt is always good. 2, understand that mortgage debt at a low rate is not the same as credit card debt. Stop treating all debt like it's equivalent. The cost matters. The purpose matters. Strategic debt used to acquire appreciating assets or invest in higher returning opportunities is not a moral failure. It's capital allocation. 3, if you do decide to pay off your mortgage early for emotional reasons, own that it's an emotional decision and understand the opportunity cost. You're buying peace of mind, fine. But that peace of mind costs somewhere between $500,000 and $1 million over 30 years, depending on your numbers. Make sure you're okay with that price. Here's the reality. Lazy investing built more fortune than crypto memes. And paying off a 3% mortgage while the market returns 8% is not lazy investing. It's active wealth destruction disguised as financial responsibility. Most people will never get this because it requires you to think like a business, not like your parents. But if you're watching this channel, you're not most people.